So what I'll do is I'll read off the answers to the multiple choice questions, and you can stop me if you're like, oh, wait a minute, I'm missing how you got that answer, right? So as opposed to going through each and every one of them. All right, ready? Ready? Pencils ready? We'll give you club. Okay. First, the first is A.
I got one.
There you go. That's a good start.
Wait, is that a worse feeling on the first question wrong? Like, okay, well.
Okay. Everyone got that? A. Second is C. The third is C. Is that a hand? No. Celebrate. Okay. Everyone got that? Second is C. Third is C. 4 is A.
It's getting rougher.
5 is D.
As in dog?
Yes, D is in darling. 6 is A.
Absolutely.
7 is B. 8 is B. B. 9 is A. Oh, we got 100%. Okay, so let me take a moment and read it. Okay, so the reason is because a purchase order is what the company issues to a vendor, and so that basically puts the company in a position of contracting with that vendor to purchase goods, right? So you want to limit access to purchase orders and have controls over purchase orders, because the vendor is not going to know if it's a purchase order coming from that company on the company's letterhead. The vendor doesn't know that, so they just know that we got this purchase order from you, we shipped it where you told us to ship it, it's your responsibility. So at that point, you've committed unauthorized purchases were made.
Can you recite 7?
Okay. Right, so remember, the search fund recorded liabilities is you're trying to identify any liabilities that should have been recorded as of year end, but the company didn't. So basically, understatement of liabilities. And so by comparing cash payments, disbursements made after the balance sheet date or year end, and tracing those or reviewing the accounts payable trial balance, you're trying to identify whether or not those cash payments actually should have been recorded, right?
Okay. So you would look at all of them, not like a sample.
Right. But so you would normally look at payments occurring within a period of time. So maybe you could look at the auditor decides based on their judgment whether they want to look at cash payments in the month of January or the first 2 weeks in January.
Okay.
I did. So it's 9. Number 10 is B. Number 11 is B. Yes.
11.
Okay. Okay, right. So what you're trying to do with subsequent cash collections is you're trying to determine you're trying to determine whether or not that accounts receivable. So if the accounts receivable was collected, right? I mean, if you receive a cash collection, then that tells you that the accounts receivable was collected. Because you're looking, subsequent cash collections means after year end.
Wait, but I felt like when they said like in the question, it's like asking you like how likely, like I assumed it was a receivable that you haven't been paid and you're trying to assess like the likelihood of getting that receivable.
Right, so it's outstanding as of 12/31, and one of the things you want to see is it collectible, right? So if you see subsequent cash collections, right, if you're trying to determine the collectability of that receivable, the most effective procedure is to determine whether or not the payment was made subsequent to year end, right? Because then that would tell you that it's paid, right? It not only gives you information about existence of the receivable, it also lets you know that that receivable is collectible because you collected on it. Its subsequent cash receipts occur after year end. So you could take a look at what has happened to derive information or evidence about the existing balance as of year end.
But if it's already been paid, then why would you determine the collectability at all?
It hasn't been paid as of 12/31, right? So remember, auditors are coming in and they're auditing the balance as of 12/31. So you don't know, as of 12/31, nothing happened, right? It was there on the books as an accounts receivable, right? So so if the auditor is like, okay, well, is this collectible? One way, because they still have to gather evidence about it, not as though looking at it, it was collected necessarily. What was the collectability as of 12/31? Right, so you're getting, so you have subsequent cash receipts are probably the best, most definitive evidence that you can get about accounts receivable. It tells you about the valuation of that accounts receivable. It tells you about the existence of that receivable, and it tells you about the collectability because you actually collected the money. So you're you're gathering evidence about something that existed as of 12/31 because you're in there. You could look at the future in essence, right, and see what happened subsequent to year end.
Wait, so if you were like trying to verify whether or not the reserve balance was accurate, then would you look at like the authorization of credit?
Well, the authorization doesn't tell you whether or not, authorization of credit sales doesn't tell you whether or not they're collectible. What that tells you, that's a control. That gives you information about the credit worthiness of the customer, which could impact valuation. Number 12 is A. Number 13 is D. Number 14 is D. Number 15 is C.
Can you go over 14?
Sure. So, the cashier receives the remittances. If they also posted the accounts receivable, they could steal the cash and post like a write-off, you know?
But like, if they make the deposit, can they also steal the cash?
No. Well, but somebody else would detect it, right? Because somebody else is updating, right? Somebody else is updating and reconciling. But this person has custody of the asset and reporting responsibility. That's an incompatible,
Okay.
right? Yes.
So if you like prepare the check, how can you endorse to see the check?
In the
The cashier doesn't prepare, this is a cash receipt. They're not preparing the check.
Prepares the daily deposit.
Deposit. Right, do you see, Stephanie? Because you have custody of an asset and you're also recording, updating the records.
But like, you also have custody of the asset and like you're updating like you're putting the money in the bank, which.
Right, but putting the money in the bank is not recording it. Somebody else is making updating
It's like doing
the
your
accounting
journal.
record.
Okay.
And somebody else is going to be doing the bank reconciliation as well.
Okay.
15 is C. Sixteen is C. 17 is B.
B.
18 is A. 19 is D. 20 is A. 21 is B. 22 is A. 23 is A. 24 is B.
Are you sure?
What do you think it is?
I thought it was D.
So what does it say? It says would otherwise be misleading, right? So that would, so the audit, you would never want to present financial statements that are misleading just so that they would comply with GAAP. So there's a valid reason, the auditor concurs with that reason, right, for the departure, so you would then, you wouldn't issue an adverse opinion, you issue a qualified opinion. Twenty-five is A. 26 is A.
Wait, can you go over 25?
Okay,
Sorry.
no, that's why we're here. Key point here, Green applied other procedures and was satisfied as to the reasonableness of the account balance. So there was no scope limitation.
So like even though like he started after, like he still got everything done. Like
Yeah, he gathered evidence about what's recorded in the financial statements.
Okay.
Yeah. 27 is B.
You said D? Like
B,
dog?
B,
Oh,
like Brent.
How about 26?
26 is A. 28 is D.
I'm sorry, I missed
27 is B.
Wait, why is, can you explain 27? Why isn't it audit report release date? That's what I thought it was.
Because the auditor, think about, with the audit date, what auditors are taking responsibility for is that I obtain sufficient and appropriate audit evidence. If something so that's the subsequent events, right? If something happens after if something happens to the release date, right, the auditor then has to go back and they have to decide how they're gonna handle it. In that case, they would dual date the audit report.
So that
So, because they're only gonna take responsibility for that one item. Right, because otherwise between those two, they would be responsible for everything, right? So they would go back and dual date the report and say, we're taking responsibility. So it's our audit report date, except for, right? This one note, and refer to a note, whatever, I forgot how the wording is. So they're only gonna take responsibility for that one of whatever that subsequently discovered fact is. So when auditors give an opinion, they're giving an opinion on the work that they've done as of the audit, as of the auditor's report date. Now, what the auditor can do is decide if they decide to do more work, then what they're doing is extending the audit report date. So they would change the audit report date. But if they choose not to do more work, then they're going to dual date the report.
And that dual date is between the period of the financial statements and
The period of the date of the auditor's report.
Yeah.
Mhm.
Okay.
Wait, can you say that again? So when you dual date, it's from the date of the auditor's.
No. So when you dual date, it's usually because there's a subsequently discovered fact, right? So you've already signed off, you've considered subsequent events and so forth. Then you find something out. Right? So what the auditor would do in that case is, because they could have two choices. They could go back and do additional work and change the audit report date. Or they can leave the audit report, because at that point, if they decide to go back and do additional work, they can't just do additional work for that one item. They have to do additional work to cover that entire number of days, weeks, whatever, right? And then they change the audit report date. Or they can take responsibility for that, what they've done as of the audit report date, and then that one item. So and that's when they would dual date the report.
After it was released.
No,
Like,
so after it's released, then the auditor has, the report is released to the
Yeah.
public. If they find something out, they have to evaluate that. Let's say it's significant and it requires, it's something that the auditor believes should be adjust the financial statements. If they believe it should, would result in adjustments to the financial statements because it was a condition that existed as of,
Yeah.
then they would go back and request that the client reissue their financial statements,
Okay.
right? If it's disclosure, they would go back and say you should disclose. If the client refuses, the auditor would, obviously have to contact the, not authorities, but regulators for publicly known company for those short terms. So I think I left off it, I said 28 is D, 29 is A. Mhm. And it's the same reasoning as 27. And 30 is C. So everybody got 100% on multiple choice?
Yeah.
All right. So now let's look at internal controls and assertions. So the first one, vendor's monthly statements reconciled with individual accounts, payable account. What'd you have?
A.
What do you think?
See?
What's C? Oh, yes. Yeah. Accuracy, right? If you're reconciling the monthly statements with the individual accounts, payable accounts, you're trying to, that's the purpose of reconciling, to identify any reconciling items with respect to, your focus is accuracy. What about number 2? Whose purchase is the result? Like if you purchase something that is considered what? Type of- It's a transaction, so we know we're dealing with assertions about transactions and events. So this control is meant to address what? all purchases are made on the approved purchase rate. What makes it, so what's the objective here? It's occurrence. Is validity. Is it a valid transaction? So it's validity. So occurrence. This is the. What about number 3? What do you think? Completeness, right? That was, by having this control, you ensure that invoices are recorded, so that you recorded the liability. What about 4? See. So everyone thinks C. It's occurrence, right? Are vendor invoices matched against the purchase orders and receiving reports before a liability is reported? Right? So is that a valid liability? The receiving report is what triggers the recording of a liability. And is it a valid? Right? So is it valid? And did it occur? Did it happen? So that's the receiving report. Right? We receive something, we should record it. And it's an approved purchase, it's a valid purchase. So it's occurrence. What about 5? C, yes. What about number 6? Cut off. What about number 7? Because is it valid, right? Is it a valid, did this transaction occur? Did we return something to, did we return goods to a vendor? Did we, so is it a valid transaction? What about 8?
B.
Right. Completeness. Question. So how was that one? What was difficult?
Similar to this kind of, when you say assertions on the exam, will it be similar problem like this? Situation and then tell me the important, I mean the assertions and
Yeah, where I give you an audit procedure and ask you what assertion does this audit procedure address, or I can give you something similar to this, a control. What assertion does it address? Okay.
Like the
Oh, yeah. Because I thought like I'll read something and so then I go back to that's what I
Right, so the thing with assertions is, right, remember the objective, assertions are tied to gap. And so when auditors are, say for example, if I gave you an audit procedure, what is it you're gonna get evidence? Like when I perform this procedure, what will I know? Right? What's the objective of performing this procedure? So for example, if I say, select a sample of shipping documents and vouch those to the sales journal, what will you know when you do that? If I select a sample of shipping documents, source documents, right, and I vouch those back to the sales journal, what am I going to know once I perform that procedure? Right, well, but what do you know?
are the sales recorded? Are the
You know that valid sales are recorded, right? And that's how you have to think about the procedure, right? Versus it.
It's an easy one. It's like an easy one. We've already seen it so many times.
Okay. No, I'm sorry I use that one all the time. But the objective is for you to think about, well, what will I, so, no. So if you think about it in that way, yes, you've seen that one all the time. So what you just told me is you memorized it. It just
I
sticks out of your
understand that.
memory.
No, I will understand
That's
that.
what I want you to do. Make sure that you understand it, right? So that's the point of saying, well, when I perform, what will I know by doing this? Like, what evidence am I getting? Right? And so that helps you to identify. Let me see if I can think of something hard. I was saving a hard one for the exam.
I prefer.
Well, they're really not hard.
And let's do the same.
No, I think about it.
We have to study and see.
No. No. All right, well, let's kind of walk through the second problem because it's more searches and this kind of thing. So this is dealing with audit procedures, right? So let's take, I confirm accounts receivable. By performing that, what does that tell me? When I confirm with a customer,
If they exist.
but what does it tell you? You're telling me the assertion.
That is what's there.
That they actually
That's a so what it tells you, right, is that accounts receivable balance as of 12/31 is a valid balance, right? Because it exists. It's supposed to be there, right? Because you don't get enough information about receivables. You get limited information about accounts receivables by testing occurrence, right? Because what occurrence tells you, so by testing the sales side of that transaction, the revenue side of it, it gives you limited information. So if you perform occurrence, if you perform tests, gather evidence about occurrence, you do know then that this was a valid, this accounts receivable was generated, everything was reported correctly, right? But you don't know that as of the reporting date, the balance sheet date, that accounts receivable is still viable, right? That it's still valid. You don't know if it's been paid off. You don't know if the customer returned the goods. You don't know anything about it, that transaction, except that, we created an accounts receivable, we should have, but we don't know anything about whether that accounts receivable still exists. So the objective of confirming accounts receivable is to gather evidence that the accounts receivable is valid. It's the company owns the company correctly recorded, should have a receivable recorded for that customer. Okay, so, and you're right, Stephanie, it's existence. And also remember, confirmations of accounts receivable are required by the standards. Auditors have to confirm accounts receivable unless they, find out that for whatever reason they can justify that they're not going to get, responses, that it's not material or so forth. Right? They have to have a valid reason. Okay. Review sales returns after the balance sheet date. Right? We reviewed sales returns after the balance sheet date to determine whether they are applicable to the current year. Right? Because after the balance, so that's the key there. That's the key thing. What will you know? Right? That's the key thing. If you're looking at something after the balance sheet date, right? What you want to, you're not testing existence of the sales returns, right? You're trying to determine, you're trying to determine whether or not they're recorded in the right period. Account for the numerical sequence of sales orders, invoices, and credit memos. Numerical sequence, what does that tell you?
I have existence.
So if you account for the numerical sequence, how does it tell you that the account exists? That it's valid as of that date?
Because if they're only one.
And if sales orders, invoices, credit memo, transactions. because you're not testing occurrence because you're not tracing it to, or vouching it to sales journal, right? So you're not getting anything about the report. You're just accounting for the numerical sequence.
Because if you're missing a number, then you know something's missing, and it's not.
And that would be, you know, something's missing.
So it's not.
Completeness.
Completeness.
Yeah, okay. Yeah, she said that, and I agree.
Completeness. Right? That's all you know when you're accounting for the numerical sequence. Is completeness. And this would be, right? That's it. That's the only thing you know. What about 4?
Valuation.
Okay. Yes.
Yes.
But it's also, so this problem is one of my problems where I didn't word it the way I should have. But one thing you also get with subsequent cash receipts is existence as well. So subsequent cash receipts is an alternative audit procedures that auditors can perform or should perform if they don't receive the confirmations, right? So it also gives you information
So
about.
if I was to put existence instead of valuation, that's what they're
Yeah, because of the way I worded it. But if I don't have that evaluate there, don't. It's only because the word evaluate is there. Yeah, it's true. I would put it existing, but I can see why students would think evaluation. So I try not to word it. I try to be very clean in my wording when I talk about assertions. Only because the word evaluate is there. But normally, my objective with this question was subsequent cash receipts to get at existence. But I would have, because of the way it's worded, I would have accepted evaluation as well. What about number 5? Right. Right, because you're starting with the sales journal and tying it to source documentation. Occurrence. What about number 6? Recomputing the information on the sales invoice. What about number 7?
I had rights and also.
Budget 5, 6.
5 was occurrence, 6 accuracy. So let's think. So what will you know when you perform? When you review the receivables on the age trial balance for notes and related party receivables, what will you know? Just that
The
procedure.
value of their account.
How? How do you know the value of the accounts? What in that procedure
From-
gave you any information about the value of the accounts? You review the receivables on the age trial balance for notes and related party receivables. So in other words, you're looking at it to determine if there are any notes or related party receivables recorded in the accounts receivable age trial balance. That's all you know. Classification. Like that's all. So that's that's where what happens. I think, especially talking to you guys after exams, is you start to add stuff to the procedure. It's like, oh well, if I did that, I'm going to do this. I'm going to do that. And I'm going to do this. That's why they're doing it, because I need to know. Because you're already anchoring on, right? You're anchoring on that I have to get evidence. But remember, auditors are gathering evidence about all of the assertions, not just the ones we kind of harp on in class, right? They're about all this. So the only thing you know when you perform that procedure is, whether or not there are any notes or related party receivables recorded in the age trial balance, which it should not be, right? Because the age trial balance should represent the trade receivables, and only customer account receivables should be recorded in the age trial balance. That's the only thing you're going to be aging. Right? That's where your valuation allowance comes in at. Make sense? Yes, no? What about number 8? Rights.
Wait for number 8.
Mhm.
Because,
You're gonna review the minutes of the board for any indication of pledge or factored accounts receivable. So you will know,
who's not supposed to be there or whatever.
well, you'll know if they have sold their accounts receivable or borrowed against their accounts receivable. So what that tells you is that if they borrowed against their accounts receivable by factoring or pledging, that when the receipts come in from those, when they collect on those accounts receivable, they have to remit the funds to a third party. So they don't have rights to those receipts. What about number 9? Hmm? What will you know? It's invoices for evidence of credit.
Occurrence.
Hmm?
Occurrence.
Accuracy and valuation. Right, accuracy more from the test of internal controls, and valuation some more indirect, because if the control fails or is not performed effectively, then it results in the company potentially making sales to customers who are not creditworthy. Right? They could,
So we will get it right for other.
If you're looking at it and it says that like you're examining the invoices for the credit approval, aren't you just looking to see whether or not like it went through internal controls and like they did like it's
that they approved it.
yeah. So, so that's accuracy.
Or, yeah, accuracy more directly evaluation. The accuracy, the control is operative, right? So accuracy and valuation, that's why that one I said both. What about 10? Completeness, right? You're starting with the source document, and you're going to read what's recorded. You're trying to determine that everything that should be recorded has been recorded. Oh, we didn't do types of tests, sorry about that. So, number 1, what type of test? So remember, we have 2 types of tests. Test of controls and substantive tests. And within substantive tests, we have 3 types of substantive tests. Substantive tests to transactions, which are those items that are flowing through the income statement. That's your transactions flow through your income statement. Substantive tests of account balances, or sometimes detailed account balances, at your balance sheet. And substantive analytical procedures, which is basically when you're comparing or scanning. So of those 3, substantive procedures, substantive analytical procedures are the least effective of the 3. So auditors would never just focus on substantive analytical procedures as evidence for revenue. They would use it to corroborate evidence gathered from other audit procedures. So that being said, and so test of controls, right? So the way to think about substantive tests versus test of controls. So substantive tests, right? You're gathering information about what's recorded, right? The amounts that are recorded in the financial statements. Whereas test of controls, you're gathering evidence about the process, right? That lead to the process over recording things in the financial statements. So, number 1, confirming accounts receivable is what type of test? Right, substantive test, right? Accounts receivable, balance sheet, substantive test, account balance. What about number 2? Substantive test of transactions. What about number 3? So what's the objective of looking at subsequent cash receipts? So the thing about the assertion, which you told me, you said it was valuation in existence. Valuation in existence applies to what types of assertions? Account balances. What about number 5? Transactions. And this could actually be, even though I didn't have it down here, a dual purpose test, right? Which would be both a test of controls and a test of transactions. And normally, and the reason it would be a dual purpose test is because you're gathering evidence not only about what's recorded, the transaction that's recorded, but also about the control process. What about number 6? I heard test of controls. Okay. What about number 7? Balances, right? Number 7, tested balances, standard tested balances. Number 8, substandard tested balance. Number 9, tested controls. Number 10, transactions. The action could be similar to number 5. It could be considered a dual purpose test as well. So by performing this audit procedure, you gather evidence about the control over the process as well as the amounts reported. Substantive test of account balance. Question. Someone sent me an email about, did you, is that clear to you? Or
Yeah,
you
it's
want me to
a
go over
little
to-
clear. It's a little clear. I'm still gonna go over it.
Okay. All right, so the next one deals with subsequent events.
I know this is a lot.
If you put it in the atmosphere, then you realize it. So you're gonna say, this is good. Don't think back. Remember confirmation? Okay, whatever works. I just wanna put good vibes in it. And if you say it's bad, then it's a self-fulfilling prophecy. So let's think positive. Don't speak it into existence. You're gonna be, I'm studying. I'm gonna be prepared for this exam.
actually want everything
Yeah.
I want to take this exam.
No. She said she's gonna get. We'll get hit by cars before we know.
Whoa. No.
Just me. I didn't know you guys. Okay.
All right. What about number 1?
I had D.
It's D. Right? So here's the important dates, right? The audit report date, which is the date that the auditor determines that they've collected sufficient and appropriate audit evidence, right, is 3/17. The release date is the 29th, and the financial statement date is December 31st. So in this case, right, on April 5th, right, so this is past the audit report release date, which takes it into a subsequently discovered fact, right? They discovered it after the report was released. So that immediately tells you it's either going to be C or D. And in this case, right, it's a flood destroyed the uninsured inventory, but it happened after the reporting date, right? So that's an event, right, that wasn't a condition that existed, right? It's something that would have been disclosed. So that's why they would request D, request the client revise and reissue to December 31st. Should involve the addition of a footnote, but no adjustment No adjustment would have been required.
One?
No, it's D.
Yeah.
Yeah.
Wait, why is there no adjustment?
Because the fire occurred after the balance sheet date. So that existence, that event, that did not exist as of the balance sheet date. Right, so when you, if it does, so let's say that they had discovered this on, before the end of the audit, right, before the audit report date. Let's say they discovered this, then they would evaluate this as a subsequent event, right? And they would say, did the condition exist as of the balance sheet date? If the answer is no, then you disclose. And so February 16th is as of the balance, the fire happened after, the flood, I'm sorry, happened after year end. So it's not a condition that existed as of the balance sheet date. Right? The balance sheet date is 2011, December 31st, 2011.
You would, like, what an example of where like word provision would be, like, so let's say like a lawsuit, like in this case, I guess 2011.
No, what would be,
But-
I'll give you,
but you
let's
have-
use the same one. If the auditors found out that the flood occurred on December 31st, 2011, then they would adjust the financial statements.
I was talking about, I thought like my example was gonna be like if you had like the lawsuit pending and like you were pretty sure you were gonna lose, you already had the liability written like in your financial statements for like let's say $3 million, then you ended up like paying January 10th $3.5 million. But
Right,
you have
then
to-
that's
you
a
have to go
subsequent
back-
event,
you have to go back and adjust.
All right, is that clear, Shannon?
Kind of, yeah.
Right, so so let's start, you agree that it's a subsequently discovered fact, you see that, right? And so now the auditor has to determine, so that is an event that happened, or something happened, but it happened before the audit report date, and it happened before the audit release date. But the auditors did not find out about it until after those two, until after the audit, the report release date. So they would go back and treat this like what would have happened had we found out about it before that, right? And so in that case, they would go back and request that the client be advised and we issue the report, but disclose the item because it's not an item that would have required adjustment to the financial statement.
These happen after, so yes, like that.
Right. Okay. So what about number 2? What do you think? Yeah, it's B, right? Because on February 17th, the auditor discovered it. So this is before the audit report date. So it's automatically subsequent effect, right? That they destroyed. So disclose the information in a footnote, right? Because again, it's not a condition that existed as of the balance sheet date. So they would just disclose it. Prior disclosure because it's significant. What about number 3? Is that it? It's A.
No. C.
A,
Why?
Shannon. Wouldn't it be A?
Because, no, look, it's A.
Yeah, it is A.
It's A.
Yeah,
Yeah, it is A.
okay.
Right? On February 7th, you discussed, so first of all, you have issued your audit report.
Okay.
All right. This is why we're doing this.
This is rough.
You know what I think? I think because they're so similar.
Yeah.
But yeah,
We're
that's the
missing like
point.
key things.
But that's the point, right? Is, so, and what happens when it's like, well, what's different about it?
I'm still not gonna. I know.
Right? So you think 2 of these are similar, then what's different? So you have to look at what's different, and the dates are different. When the auditor discovers it, it's different. What about number 4?
I have an E.
Yes.
Yeah.
It's E.
Let's see what your let's see.
What about, right, does everyone see why that's E? Everyone agrees with that? What about number 5? C is right. See the difference?
Can you explain? So I get that the balance sheet date ends on December 31st, but then are they required? So are the auditors required to give an opinion on everything until March 29th, or only until March 17th?
No, so the auditor, right, they take their report, and the opinion date
Yeah.
is the date of their, when they decided, and in this example, this is the 17th of March, that they collected sufficient and appropriate evidence.
So up until that day,
Right,
everything
so
that-
they would evaluate events occurring after year end to determine, up until that day, right, to determine what impact it has, if any, on the financial statements.
up until just the 17th.
Right, but but that small, short period between the audit report date and the release date, if they find out information, right, that's considered a subsequently discovered fact. And then they determine what impact that would have in that short window. So if they discover it in that short window, yes.
Why is 1B and 5 is C? Because they both occur after the balance sheet date. But like, why do you have to adjust for 5 and not 1?
Because 5 is a condition that existed it's a type 1. It existed as of the balance sheet date. The event, the creditor went bankrupt in January. So, okay, this is before the auditor even signed off. But also, this is a condition, if someone goes bankrupt, the likelihood is that there's an issue in the financial statements, right? That in your accounts receivable. That's a condition that existed as of the balance sheet date. It's unusual for a company to go bankrupt, be healthy on December 31st, and then, ooh, I'm going bankrupt 6 days later. There's probably evidence that would suggest in their aging, in their accounts receivable valuation, that this particular debtor was a problem. So they would have to adjust the financial statement. So it's a type 1 event. Whereas D, right, 1, it's not a type 1 event, it's a type 2 event.
Professor, and all these steps have to be done even though you don't sign the unqualified report.
I don't understand.
It doesn't matter what if the report is unqualified or modified or what is
Right, because these are.
Doesn't matter.
Right, so this would drive the type of report that's issued. So if the client, let's say the auditor, let's say in example 5, right, the auditor said, oh, we need to adjust the financial statements. And the client refuses to adjust the financial statements, then the auditor would possibly qualify the opinion, right? Because assuming that this is material, then the financial statements would be materially mistaken. So they would qualify the opinion. But only that's in response to the client. So right now, they're going to propose an adjustment, and the client would hopefully make the adjustment. If they don't make the adjustment, then it would be a material misstatement. And that would result in the auditor making a determination of either qualifying or
If they can issue opinion, does all these things matter later on?
So these things are considered in there. So some things, right? So in D and C, the auditors already issued their audit opinion,
Yes.
right? Because it's after the report release
Yes.
date. So they would go back and determine whether they would, as it says, request that the client revise and reissue. If the client refuses to revise and reissue, right, then they'll take other steps such as notifying the people who still, rely on the financial statement. But if it's a publicly held company, you would notify regulators. So they've already issued their opinion. So the client will go back. If the client goes back and revises their opinion on the financials, not their opinion, sorry, they make the appropriate disclosures or appropriate adjustments, then the opinion wouldn't change, right? The only way they would revise their opinion is if the opinion changes as a result of these events. Okay, any other questions on subsequent events?
No, that makes sense.
All right, so I'll just read off because I want to make sure we spend time talking about audit reports going into that. So acquisition and expenditure cycle, number 1 is G, which is the debit memo. Number 2 is F, which is a vendor's invoice. 3 is B, the purchase order. 4 is the accounts payable trial balance. 5 is voucher, H. 6 is the purchase requisition, A. And 7 is M, the cash disbursement journal. Okay. So, audit report. So, number 1, what do you think? Right, it's a departure from GAAP. Right, so you would issue, and it's, the auditor thought it was pervasive throughout the financial statement, so you issue an adverse opinion. What
But it
about?
doesn't say. But it doesn't say that it's a departure from GAAP.
Oh, well,
Pervasive.
Vector carries its property, plant, and equipment at current market values. That's a departure from GAAP, right?
Well, yeah.
GAAP is historically, right?
Isn't pervasive like the same thing? Like,
What?
if it's pervasive, that
No,
means
that
it
just
goes
means
against
that like
that.
it occurs.
No, that what it goes against GAAP and the effect. And the effect of it is pervasive. The
Okay.
effect of that departure is pervasive.
Okay.
Okay. What about number 2?
G.
Yep, G. It's a scope limitation and it's a client imposed scope limitation. What about 3?
I could. Never mind.
It's A, right? You were unable to confirm, but because they were able to perform alternative procedures, they can issue a standard unqualified opinion.
So like you don't have to explain that you didn't do like the standard one, like something else. As long as you come to like the same conclusion.
Yeah, as long as you you've been able to
The
have
reasonable-
sufficient and appropriate evidence.
Yeah. Okay.
What about number 4? G, right. What about number, well, I'll tell you this one since I told you that I wasn't going to ask you about component auditors. So this is E.
Number 5. Number 5.
Yeah, number 5 is E. I'm not going to ask you about component auditors on the exam.
Wait,
But if you want to read more about it, it's page 555.
wait, you can do that?
Hmm.
You can ask like auditors from different firms, like.
Yeah, and that's common, right? Because especially when you have large multinational companies, and so what's interesting is firms. Some, you might have, that company might have, they might have acquired another company somewhere else, and that other company is audited by a different audit firm. So, they might not switch auditors right away. So that, as long as if it's significant and material, then part of the company, then you can, that happens. That happens more often than not, where you can have audits. Even in some firms, they might not have, let's say, an office in a particular country, even a big four, right? So they'll partner with another global firm, and that firm works with them.
Do you have to get like permission from a client on that? It's like that firm, even though like technically they're not the auditors, like
Well, you would do that during the engagement process in your discussion with the audit committee and the board, right? That we will be using other auditors to help us in this area.
Would that be like frequently seen, like whatever it has to it's like on an audit, like at the oil rigs and wherever. Let's not go there and after.
Well, yeah, if the company, but I think if the firm has a lot of business in that area, so they do, or it's significant enough revenues being generated, then they might have a small office in that area. Or they might choose to send people from another office to go. So it really depends on what the firm's criteria is. What about number 6?
D.
Right. D, right? Substantial doubt about their ability to continue to go concern. And remember, the explanatory paragraph is after the opinion paragraph. So that's going to be key, right? Make sure you understand the difference between an additional paragraph that's added, such as for an except for opinion or for scope limitations, and what is considered an emphasis of matter or other paragraph that follows the opinion. So make sure you understand those situations. What about number 7?
A. I had D, not A.
Is D, because they changed, right? They changed, they're moving from one gap method to another gap method, but this is the consistency.
Because it's in accordance with GAP.
Right, it's in accordance with gap, but you want to highlight this too. So remember, it's emphasis of matters and other paragraphs. So emphasis of matters is meant to provide information to the readers about, emphasize things about the financial statements that you want to bring to the reader's attention. Other matter paragraphs of things about the audit, for example. What about number 8? Right, it's C, right? So this is a subsequent event, right? So, certainly 10 days after, the auditors have not signed off on the opinion, so they're still in the process of gathering audit evidence, right? They probably haven't even arrived 10 days after hearing, right, after the balance sheet day, right? So the client, this is an event that existed as that should be disclosed in the footnotes, right? It's significant, it's material. So in this case, the auditor would qualify the opinion paragraph. All right, so let's just quickly talk about last 2 minutes or so. Yes.
Is the format going to be the same? So everything else is joined by program?
So probably not a little longer. You'll more than likely, it'll probably be about 25 multiple-choice questions, and more problems, but broken down into subsections. And the objective of doing that is to give you more opportunities to learn those. So because multiple choice questions are usually 2 points, this way you just spread it out. But
It could be 50/50 then.
yes.
Yay. Thank you.
Now you're thinking, I want you to remember that. And when you give me the evil eye,
It's fine. I'm still gonna fail.
And there's no extra credit.
I'll probably put, no, there's no need to have extra credit because the class average is over 80 that high. So I don't, the class average is that high. But what I will probably do is just give you the opportunity to just, earn bonus points on the exam.
Yeah.
So that's what I'm doing. Okay, so. Alright, so the chapter, so as I said, it's not cumulative with an asterisk. Because I will be testing, and I'll talk about this in more detail as I go through each of the chapters. You're going to have to know assertions, obviously, and you're going to have to know controls, so control activities. So the chapters that I'm going to cover, and the reason that I have internal controls in here is because the focus is on internal control evaluation and risk assessment related to the revenue and expenditure cycles, right? So just related to those 2 cycles. I'm not going to ask you about the COSO framework or anything like that, focusing on control activities for those cycles. Chapter 7, the revenue collection cycle, acquisition and expenditure cycle, completing the audit and audit reports. And so the format, as I said, will be 25 multiple choice questions, probably more like 5 problems, but there'll be subsections to the problem. So if you have 3 hours to take an exam, so you'll have more than enough time to take the exam. And with the objective of trying to spread the points out and not having any one problem be a substantial amount of points. We talked about study tips already. I know some of you have already contacted me, you've been studying. At this point, you guys are in the midst of finals coming up. It's not worth it to reread the chapters. I think the best use of your time is just to try to work through problems. That would be my suggestion to you. There will be management assertions. Remember, it's important to think, when I ask you about assertions, you need to remember that I'm asking you about the assertions based on the ASD description of the assertions, which the only difference is that ASD breaks the assertions down into categories. Transactions and events, things through the income statement, account balances, which represent balance sheet accounts, and then how things are presented in the financial statements as a whole and disclosed in the financial statements. When I talk about transaction-related audit objectives, what I'm getting at here is that, remember, the objective of the audit is for auditors to gather evidence about the assertions that management makes. So if management's assertion is about occurrence, what the auditors are trying to determine or gather evidence about is that sales are for shipments, right? They occur, and those shipments were made to valid customers. They're talking about completeness, right? And everything that should be recorded has been recorded. So existing sales transactions are recorded. So the audit procedures are meant to gather evidence about the assertions that management makes. And again, recall that the assertions are linked or tied to generally accepted accounting principles to GAAP. Internal controls, things that I'm looking at, how does the auditor gain an understanding of internal controls as it pertains to the revenue and expenditure cycle, and that's just overall understanding the key functions in those cycles, and so thinking through what should occur in the credit approval process, right? The granted credit. Be able to identify violations and segregation of duties for those cycles. be able to identify internal control strengths and weaknesses in the various cycles. So when we think about internal controls, remember internal controls are designed to address the risk. And so you think about what could go wrong, and is the control effective to address what could go wrong? So again, sales revenues reported when goods had not been shipped to the customer. That's what assertion is violated there. Occurrence, right? And so the auditor wants to see a control activity that addresses the validity of sales were being reported, right? That the sales are earned. So control activity that the client would have in place would be that all sales invoices are matched to shipping documents before reporting them in the sales journal. Right? The auditor would test that control activity by selecting a sample of sales entries made in the sales journal and comparing those to the time date stamp of the sales revenue entry to the time date stamp on the shipping document. So basically compare it to a shipping document. So what could go wrong and how does is the control activity effective to address that risk of what could go wrong? So I send you back to chapter 5. These problems that I'm suggesting to you are problems that are dealing with control activities related to the revenue and the acquisition and expenditure cycle. So these problems relate specifically to those. It's just suggested problems that you want to go through. I've already posted the solutions to each of these problems that I'm suggesting to you on Blackboard. The sales and collection cycle, chapter 7. You should know what the key business functions are, what the transaction-related audit objectives are for sales and cash receipts. Again, that's the auditor's response to the assertions that clients are making, what the key controls look like, and what kind of testing those controls auditors will perform, and then substantive audit procedures. And again, remember, substantive audit procedures is substantive test of account balances, test of transactions, and analytical procedures. So again, you have all of this. These are the key accounts, key journals that are used, and key source documents for this sales and collection cycle. Again, here's some suggested problems that you want to go through and make sure you understand it. And these problems cover both revenue type procedures as well as receivables. Chapter 8 deals with the acquisition and expenditure cycle, same thing. Key business functions, what are the key audit objectives? What are the controls? What is what substantive tests we perform? Keep in mind, in this cycle, one of the big risks would be unreported liabilities or unreported expenses. And again, the key accounts and the key journals. Again, a couple of problems that you want to review. I think one of these problems deals with search for unreported liabilities. Completing the audit, we went through with the mock exam, is what are the different tasks that the auditors are going to perform? What do they do in review of contingent liabilities and commitments? Review of subsequent events? What's the final evidence accumulation? So there's the auditors have to take a kind of step back, analytical procedures, identify does it make sense, and given the information that are collected, their communications with management. This is right from the notes, the timeline in terms of where auditors' responsibilities lie, and how it impacts the account. Know the difference between a type 1 and type 2. Right? A type 1 subsequent event is going to require adjustment to the financial statements. A type 2 is going to require disclosure to the financial statements. Understand what it means and what auditors' responsibilities are with respect to a going concern, because that's also going to impact how the impact the report that the auditor gives. Again, some problems for you to practice. Key things with the audit report is know the different types of audit reports that can be issued, what gives rise to a qualified opinion versus an adverse opinion, what the factors are that the auditor has to consider. Also know what's going to be modified. You do not have to memorize the wording in the audit opinion, but you should know if there's a scope limitation, what's modified in the audit report. And so if there's a disclaimer of an opinion, then there's going to be more than just modifying the opinion, right? Because you're essentially saying that you can't give an opinion on the financial statements. So you're going to modify the introductory paragraph, you're going to modify the scope paragraph, and so on. So know what you should know when you issue a particular type of opinion, what gets modified in the audit report. Not what the wording is, but what's modified. And so this just, again, gives you all the conditions for qualified report and departures from a qualified report. Scope limitation, what generally gives rise to it. This is just stuff I summarized from, and I posted this. The other thing is the report on internal controls of financial reporting. Again, I'm not expecting you to memorize that long report, but just know what the contents are. What we mean by what's meant by unqualified opinion on internal controls. That means there's no material weaknesses, no scope limitations. And adverse would have one or more material weaknesses. And remember, a material weakness is different from a material misstatement. And you can have an adverse ICFR report and still have a clean audit opinion. And just one of an opinion. And again, some examples of proper. So